It's been a case of good news, bad news for Japan, as on one hand reports show GDP has risen by 4.1%, but on the other, Fitch cut Japan's sovereign credit status to the lowest level among global ratings agencies as political stalemate dims the chance that the country can curb its snowballing debt. Today I am joined by Japanese economist at Capital Economics David Ray to discuss the matter. David, what would you say are the main factors affecting the Japanese economy at the moment?
At the moment, I would say there are two main factors affecting the Japanese economy, one domestic and one international. On the domestic side, the main factor affecting the economy is reconstruction-related spending, and that covers everything from government investment through to the auto subsidy, and that's really the main driver for the economy, and it's giving a good solid boost at present to the economy. On the international side, things are really pushing in the opposite direction. It's the crisis in the Eurozone that's one of the main factors affecting the economy, and it's having a negative effect on sentiment, and that's pushing down consumer sentiment, which impacts on consumer spending, and business sentiment as well, which affects business investment. It's also having a clear effect in financial markets. It's driving the yen up, it's driving bond yields lower, and it's pushing equity markets down.
According to numbers released by the Japanese Cabinet Office, the Japanese economy grew by a robust 1% in the first 3 months of 2012 from the previous quarter. This was helped by heavy government spending last year after the tsunami and an uptick in consumer spending. Do you think the level of growth is sustainable for Japan?
Sadly, no. I think the growth of 4.1% in the first quarter is likely to be the high watermark for growth in Japan this year. And there's three reasons behind that, really. I mean, first off, consumer spending was the main boost to growth in the first quarter. And much of that came from an artificial boost to consumer spending from the auto subsidy. We are already seeing signs that is starting to fade as auto sales are beginning to pull back, and that's likely to then affect retail spending and consumer spending as a whole. And that's going to affect Q2, but when the subsidy comes to an end, which is likely to be in Q3 or Q4, auto sales and consumer spending is likely to fall back quite substantially. So that boost that we got in Q1 isn't going to last. Secondly, the investment boost from reconstruction spending will carry on to provide a support for the economy this year, but it's going to fade. It's likely to be front-loaded, and the benefit to GDP is going to diminish as the quarters go on. Finally, the global economy is also having an effect on Japan, and we think that the global economy is going to slow from where it is at present as the euro crisis escalates, and this is going to weigh on Japanese exports. When you combine that with higher imports, or particularly energy imports into Japan, it's going to reduce the benefit, the boost to the economy from net trade. So overall, I don't think that the 4.1% growth we saw in Q1 is going to be sustainable.
Fitch's ratings cut Japan's long-term foreign currency rating by 2 levels from AA to A+, the fifth highest investment grade, and warned further downgrades where possible unless the government takes new fiscal policy measures to stabilise public finances and its ratio of debt to GDP. Do you think the Japanese government is helping or hindering its economy by continuing to spend despite getting itself further into debt?
Well, first off on that, I would say that the downgrade by Fitch is just one in a series, and the markets have largely brushed them off. It's basically brushed off Fitch's downgrade. Moody downgraded Japan in November last year, and S&P downgraded them in January last year. It's not so much Japanese spending that's the problem, as at the moment particularly reconstruction spending isn't the problem. The reconstruction bonds have got a dedicated income stream to cover their bond repayments, and it's that form of spending. It's the reconstruction spending that is providing the boost to the economy. The big problem, however, is the rest of the government spending. The government is running a huge fiscal deficit. Half of its spending is financed by bond issuance, and it's got a massive debt of around 230% of GDP. Unless it does something to boost tax revenue, to cut spending for the normal budgetary expenditure, then it really will become a much greater hindrance on the economy as time goes on.
And finally, what do you think lies ahead for Japan in terms of its economy?
I think lots of challenges lie ahead at the moment. On the one hand, the population is already shrinking. Secondly, we've got the strong yen, which we think is going to appreciate further as the euro crisis escalates, and this is going to accelerate the hollowing out of the manufacturing industry. But the main problem really, I think, lies in the Parliament not being willing to address the severe structural challenges that the economy faces. And until they face up to this, or are forced to face up to this, then I don't really think we can have a very optimistic view on the long-term outlook for Japan's economy.
David, thank you. Well, that's all we've got time for just now, but stay at Dukascopy for the latest market updates. Goodbye.